Hello, everyone, and welcome to the Nasdaq Dorsey Wright podcast. We are recording here on March 4th, first podcast in the month of March. A lot of stuff going on, and so we felt it would be great to bring in John Lewis. So, John, thank you very much for joining us.
Yeah, thanks.
So, John is one of the co-heads, just as a quick introduction, one of the co-heads of the Dorsey Wright business here, senior portfolio manager for us. John, you've been doing the portfolio management stuff for just a few years at this point. So you've seen a few different kind of market environments, right?
A couple, yeah. So I don't want to say the year because then it makes me feel old, but it's been a hot minute.
Yeah, I mean, talk about a hot minute. Definitely seen a lot of stuff moving around, some hot stocks and some not so hot stocks or broader asset classes. Kind of thought it would might be best to start off with it. You track a lot of different things. Obviously, we're focused around the momentum side of things, but you track some interesting indexes that look at basically, correct me if I'm wrong, how strong or weak is momentum right now, right? And those saw a lot of action over the course of the past couple of days.
Yeah, so you're talking about the spreads, and you can find like the big one, which is like the domestic kind of large and mid cap market. RS spread is the ticker on the Dorsey Wright site. You can pull it up. We have some commentary on there from the research hub, but essentially what we're measuring there is a basket of strong stocks, so high momentum stocks, that performance versus a basket of weak stocks or laggard stocks. All we do is we take the universe and we take the top 20% just based on the trailing 12-month return, and the bottom 20%, we compare the performance every day. So as you can imagine, it's kind of like an RS chart, right? And so we want that ratio to be trending higher. And when it is, the leaders are outperforming the laggards. That's a really good environment for momentum. When it switches around and when you get the ratio going down, the laggards are outperforming the leaders, right? And that's not great for what we do because we're always concentrated where the leadership is.
But so when we see those indices, I mean, if momentum's good, they're going kind of up and to the right, right? And what we've thrown the chart up there for the normal RS spread, at least I say normal, the domestic equity, large cap, large mid focus RS spread. It's had a good run, but it's not just going up and to the right all the time in any environment.
Right. Yeah. So, I mean, you're going to have times, even in a decent momentum market, you're going to have some time where it's moving sideways and the leadership is kind of changing under the surface. And I think that we can kind of look back at like the AI trade, right? And kind of how that has changed over the past couple years. So, first we had like it was all about semiconductors, and then it kind of moved into a lot of the power generation, right? So like things like Constellation and all these places that we're going to build like these massive power plants to get the AI centers going, right? And then it kind of moved into storage like Seagate and Western Digital, like things like that. And then we're kind of moving forward. So these things kind of come in different waves, and the leadership, even in a good momentum market, the leadership can kind of change, but then it kind of keeps going. The flip side is the laggard rally. It's like the stuff that hasn't done well at all, just all of a sudden rockets to the top. And then you've got a real problem because you have to completely change the portfolio over if that turns into the new leadership.
And we saw some of that. It's happened over the past couple of years. I mean, we saw obviously last year with the
Yeah.
I don't know what you call it, the tariff meltdown, tariff tantrum, whatever you want to say, back in March, April. We saw a big downdraft in February, a little bit earlier, and then into March with the RS spread on the domestic side. But ultimately, as I think you've said, momentum, it fixes itself, right? I mean, it adjusts.
Yeah, exactly. And so even when you get a big laggard rally, so one of two things has to happen, right? That laggard rally either has to peter out and then the old leadership reasserts itself, or the laggards become the leaders and you just have to rotate into them. So one of two things happens. It does take a while for you to get there, but you're right. Like we have seen these periods where the spread has really kind of taken a downturn. We've seen a laggard rally. The tariff announcement was certainly one of those. As it turns out, like the old leadership reasserted itself, right? And kind of off we went. I think that the example that was really tough for momentum, where the old leadership didn't reassert itself right away, was like 2022 when we went from large cap growth to energy, and then energy back to large cap growth. And the time period of that and the amount of time there was enough that you had to change the portfolio, then change it back, then change it again. So, those periods are always tough for momentum. And when you see that spread going down, so it gets kind of complicated to know, like, hey, are we going to have to make wholesale changes, or is the old leadership going to reassert itself?
Right. And I mean, another area, something that you throw in, at least in the report, we have the domestic equity spread, which is the kind of main one that we look toward. But you look at three others as well. And the small cap one, maybe looking toward there, that's shown some interesting movement. Kind of almost looks like the opposite of the domestic one, really, up until the last few months.
Yeah, so on the small cap side, it hasn't done as well. So we've been kind of in a downtrend, or a larger downtrend for a while, but more recently that has started to pick up and turn around, and we've seen much better performance out of the momentum leadership on the small cap side. So that one's been kind of the outlier, a little bit of anomaly. It hasn't performed as well as the large cap spread or the international spreads that we track.
And how did that do with how did small caps do earlier this week in looking at like IWM chart doesn't look too bad, but I mean, how did some of that stuff do?
Yeah, I mean, so the spreads pulled back. So I mean, yesterday, which Tuesday the 3rd, right? So
Hmm.
it was not a great day for momentum at all, like across the board. So it was a big momentum sell off. And I think a couple things happened there. So we do see this from time to time. And it is not uncommon for you to see these kind of outlier days where momentum really sells off. And a lot of times it'll kind of regain itself and, kind of keep going. And it's almost like a sawtooth pattern, right? Where you get a few up days and then a big sell off and a few more up days and a harder sell off. But I think there are a couple things that come into play with momentum, like on a global scale, that when you get some of these events like we're seeing now, or different announcements, things like that, I think it sometimes disproportionately affects momentum, because I think there's a lot more leverage in the system in momentum strategies, right? Like a lot of people are not like leveraging up value stocks and like paying margin interest to realize fair value like 3 years down the road, right? Like if you've got leverage, you've got interest to pay, generally the momentum returns are coming now. And so I think there's just kind of more leverage in there. There's also like these momentum stocks there's a lot more traders involved with them and things like that. So they are kind of subject to that. I think that's kind of what we saw yesterday. Especially on the large cap side, the very high end of momentum was getting demolished in the morning, right? And then it really came back. So it was still down a lot more than the market, but kind of cut that underperformance in half over the course of the day. So as we were kind of monitoring that during the day, it was interesting to see like a massive sell-off in the morning, and then people kind of started accumulating some of those names. The selling kind of slowed down, and it really kind of came a lot closer to the market than when the day started.
So what do you think about those kind of days when we get maybe a big downdraft, or we get a lot of, let's say, intraday movement between the high and the low, but we don't really end up going strongly in one direction or the other by the close? Do you think that's like a predictor or anything of the stuff moving forward in your experience?
Yeah, I'm not sure if it's a huge predictor, but I do think you definitely need to string a couple days together in order for these things to kind of have any merit. These 1 day swings are, they are kind of what they are. And I think there can be, we just talked about leverage. Like, if someone wants to delever their portfolio because of geopolitical risk, they're just going to sell whatever they can get their hands on, right? I mean, it doesn't matter to them what the price is, they're just going to do it. And so these kind of 1 day events can be really shaped by that, or just other things. So I definitely think there's got to be kind of a few days of these strung together, and you need to see a little bit more of a pattern than just kind of a 1 day phenomenon.
Right. And I mean, a pattern makes sense. We've seen a pattern. Another piece, Joseph put in the report a little, I think, last week, and looking at the average S&P 500 stock volatility minus the VIX. So it's like how
Mhm.
volatile is the average stock in the S&P minus the VIX? That got pretty high, third highest reading going back to 2010. And so I think what that's showing is obviously the individual stocks, even though we haven't seen a ton of volatility from the broader market, we've seen a lot of volatility in some of those individual names. And to what you were saying before, maybe some of that volatility affects those momentum names a little bit disproportionately. Is that fair?
Yeah, I think that's fair. And I think this is the other reason why you can't, like, when we go do the RS Institutes and when we talk about it at Catapult and things like that, we always try to really hammer the point home that you can't get too cute with your momentum factor and like try to catch every wiggle, right? And this is why, right? Because these things do get volatile. You do have these big days, and eventually something's going to hit your trigger, but you can't have your system set up so sensitive that all this stuff is going to hit the trigger like at a period like this, because we're going to get some bouncing around back and forth, up and down, and this sort of thing. And you got to kind of be able to weather that storm from a short term basis and just let the kind of longer term, intermediate term trend play out.
Right. And from a longer term trend perspective, I mean, you look at global equities generally, but I mean, maybe starting on the domestic side, we're only 1.5, not even 2% off all-time highs. Like trends are still high. The trends are still good, right?
Yeah, trends are still good. Things are going okay. There's obviously a lot of stocks that still look good out there from a technical perspective, but there's also a lot that are breaking down, and that includes some of the old leadership that people think of. And so when I do the recordings for the RS spread, like on Wednesdays, we always talk about like, hey, this is the kind of environment where things break down, and you might have had them in your portfolio for a while. Like, it's really important to move on and to get kind of the new leadership and where we've seen the rotation. It's important to get that in the portfolio, because when these things go, like when the old leaders go, it's not pretty. And you got to be kind of on top of it and not get married to these things.
Right. Yeah, so I mean, being on top of it, we talk a lot about building out a process, right? Having a process-based approach toward things. I feel like we get a lot more questions about trying to maybe define a process during a time like this when people start to get worried. Which, I mean, do you have any kind of thoughts there? I mean, obviously, it's probably not the best time to be defining a process when you want to pick how you're going to sail through a storm before you're in the middle of it, right?
Yeah,
Um,
yeah, right.
but what kind of advice or perspective would you have on that and looking back for maybe someone who doesn't have one or doesn't feel super strong about the process right now?
Yeah. So, I mean, well, the first thing, like, if this is going to kind of spur you into creating a process, then, do it, right? Like, at least use this to kind of get you there, because you do need a process. It doesn't have to be like 100% systematic like we do or anything like that, but there's a number of things you can do to make it easier on yourself to kind of cut through a lot of the news headlines out there and a lot of the panic and a lot, all this other stuff. And I mean, it can be as simple as, hey, I'm going to buy 5 technical attribute stocks. I'm going to sell them when they hit 2. I'm going to put some stuff in a matrix, and when it falls out of the top half, I'm going to sell it. And you just need kind of some kind of trigger point in there so that you've got a place to take action and you just kind of know what you need to do. And the thing is, like, you're going to get some of these wrong, right? And that's totally to be expected. When we talk about putting a process in place, this is not going to be, we're not like looking to get 100% on the trades. And in actuality, you might actually get less, like, as a percentage that work out, but they're probably going to be bigger winners, right? So that's like the way trend following tends to work. But I think it's really important because there's just a lot of noise out there. And I think, especially like when you're talking to clients or things, you need to communicate like, okay, this is what we're doing. Like, we know that it works over time. We're not going to get it right every time, but we're just going to keep doing this. And no matter what the market does, we're just going to kind of keep going. And so that really becomes important at times like this. 90% of the time, it doesn't matter, right? You can just kind of go do what you're going to do. But when things get dicey and when there's a lot of kind of stuff going on, it's much, much better to have this kind of process in place so that you can just do what you need to do rather than do what everyone else is doing, which is normally not the right thing to do.
Right. And I know you talk about it a lot and looking at not shifting to that process based upon what you want the process to do at this point in time, right? I mean,
Yeah.
I think that's easy to do as well. It's like, oh, well, this time must be different, so I'm going to change things to make the back test fit what I think it should be doing. That defeats the whole purpose of having the process in the first place, right?
Yeah, I mean, constantly changing the process is a problem. And, you talk about, there's all sorts of analogies for it, but once the horse is out of the barn, like it doesn't pay to shut the door, right? The horse is gone, so you better just go get the horse, right? So
Right.
there, the process is in place for a reason, and like I said, it's not going to work every time, right? But the what we're trying to do here is get it working enough and just get the strategy. If you're using a momentum strategy, we're trying to get it to where the strength is, right? Like if you want to set up a process for a value strategy, that's great. Like you just got to set it up to get you to where the cheap stocks are. And so as long as you keep pushing this to where the high momentum names are, it should work out over time. The problem is going to be like if you don't keep pushing it to the high momentum names, right? That opportunity cost of holding a non-high momentum name in a high momentum strategy is enormous. And
Right.
that's really what does everybody in. Now, look, like you might do this and then there's a big laggard rally and you get caught and you have to change things up. I mean, that happens. But over time, like we've looked at so many back tests from us, from other people, like the factor is robust enough to handle those kind of underperformance periods. So, the outperformance that you get when momentum's working is enough to overcome that. You just might have to wait a little bit of time before that comes.
Right, right. I think that makes sense. When you're looking at rotation around things, and I mean, having different processes in place, we've seen a lot of rotation, as we talked about a little bit at the beginning, over the course of the past several weeks, maybe diving into some of that current kind of relative strength positioning. I mean, I think we'd be remiss if we didn't mention at the top end the explosion in strength in international equities that I guess has been a seemingly explosion of strength because a lot of the signals have flipped recently, but that strength has been displayed for a year plus at this point, right?
Oh yeah, yeah. I mean that's been going for a while. At the end of the year, we were pulling all the asset allocation quilts and things like that, and we hadn't seen developed and emerging markets, both of them up there at the top. Like if you run a 10, 15-year quilt, you're not going to find that, right? Until last year. So we have seen emerging kind of up there and back, but this is kind of a new deal. We haven't seen this for a long time. So that kind of combined with some of the sector shifts we've seen, this time the rotation, that part at least is different than what we've seen over the last 10 years.
Right. I mean, when we're looking at the international equity front, which area was, I guess, in looking at last year's returns, emerging markets outpaced developed markets in looking at the calendar year. But developed markets, as you said, they were a little more consistent over time. I think it was just a steadier churn higher. Which one did better from a momentum standpoint, in looking back?
Yeah, I do think that it was kind of a tale of like a half year when we look at momentum. So like if we just compare the high momentum developed and high momentum emerging, developed was much better heading into 2025 and then kind of through the middle of the year. And then it flipped and emerging started to do a lot better. I think a lot of that emerging market outperformance was the result of the continued weakening in the US dollar, right? Which is always good for international. It's generally better for emerging. I think the reason is I think a lot of the mining stocks like in South Africa, South America, that sort of thing, like those started doing really well as gold and silver really exploded as the dollar kept going down. Like these metals and mining stocks that are kind of disproportionately in emerging market indexes. I think that carried the day for a lot of these kind of high momentum emerging market strategies. So I think that was part of it. But yeah, emerging markets definitely kind of picked up at the tail end of the year. There's probably a number of reasons why, but both of them were much better than domestic last year, at least from a high momentum standpoint.
And when we're looking at movement over the past, we talked a little bit at the beginning, but we saw a pretty sharp pullback from a lot of those emerging market areas earlier in the week. I mean, emerging, I guess, what for something like South Korea, for example, that's on the developed side or emerging markets side, depending upon if you're using what FTSE or MSCI. It kind of goes
Depending,
either
yeah.
way. Yeah. But it had one of its worst days in history, but it really just moved back into a lot of these areas just seemingly moved back into more normalized ranges. Is that kind of what you'd seen?
Yeah, definitely. Like they had broken out, like that chart of EWI looks fine, right? Like it's still ranked very highly on the fund score. We've been talking about EEM, that's still ranked highly on the fund score. You just kind of look at that chart, it's kind of pulling back to where that old high was a couple years ago, where we just broke out, kind of pulling right back there. So that to me is kind of pretty normal performance. And we'll see if it holds, right? It doesn't have to hold, but a lot of these charts kind of pulled back to spots where you're like, this is probably about where we would expect it to pull back to, and see if we can hold.
Right. Maybe that could offer some opportunities moving forward. On the domestic side, I mean, looking at sectors, right? Obviously, the big deal that a lot of people have been focusing on is the weakness in software names. Technology, software, been
Yeah.
beaten up pretty bad. Large caps in general. I mean, you have something like RSP outpacing SPY. Small caps are doing a little bit better. Just that rotation away from those mega cap areas, we've seen that displayed mostly in the tech space. It's not, I think it's important to note that it's not like we saw technology go from first to 11th in the rankings. It's cooled off, but it's not drastically deteriorated. But for me, and I don't know if you feel the same, this reminds me of like, okay, well, maybe technology's not having the year that it had last year, the year that it had the year before that. It's doing not great. Software obviously not doing well, but that's why we look at relative performance, right? Other stuff that's just been doing better, right?
Yeah, and especially in technology, we can hit on that. Like you said, it didn't fall to 11th. It's now down to what, fourth, I think it is.
Hmm.
Um, and I think a lot of that's the mega cap issue, right? Like things like Nvidia, they've just, if they haven't broken down, they've just been kind of moving sideways, marking time, treading water. But we run like a momentum focused technology sector fund, right? With Invesco, that thing's been doing great this year.
Yeah.
So, I mean, that's having a bang up year. And that's a lot more like mid and small cap names in there. So there's still returns to be had in that technology sector. I think it's just not what people are used to over the last, 5 years. And I think that has caused a little bit more of a panic, because whenever like you just kind of go to the well, right? You're like, oh, I'm going to buy Nvidia. It is what it, and if that's not working, there's a little bit of a panic. There shouldn't be, but you just got to find something else that's working. And so there is stuff that's working. But then, like you mentioned, we've also seen, a big change, like energy stuff is working a lot better now. Basic materials, industrials still remains high up there on the rank. So that one kind of hasn't changed, but definitely there's been a shift so far this year.
So when you see something like, I mean, in basic materials, maybe some industrials, I mean, basic materials certainly a lot of times can be viewed as a little bit more defensively, would you say? Is that a concerning thing to you when you see the offensive technology deteriorate from a broader allocation standpoint, or just kind of normal rotation?
I think just more kind of normal rotation. I mean, I don't think basic materials necessarily has to be like a defensive type of thing. I mean, I think, we're seeing good performance out of a lot of the metal stocks and
Right.
and things like that. And so, a lot of that can just be due to like what's going on with the dollar, or, if we've got, other things going on in the economy, things like that. So, we'll see whether that has legs and whether that can keep going. Um, we can get kind of quote offense from anywhere really. As long as we get a sector that's going through some kind of like dynamic change, and there's a lot going on in that sector. Something like healthcare, which is kind of quote a defensive sector, right, can become like a high momentum sector and stay there for a while. Like consumer staples years and years ago was actually like really good. There were some names that just really went and they went and they went, and like it wasn't really defensive. So yeah, I mean these things kind of come and go, and I think like using the Dolly tool, for example, it's really easy to see, like what's happening, where things are moving, and like, okay, maybe this theme, like I gotta kind of back off on it and look for something else.
Great. Well, John, I think it's a great place to leave it. Unless there's more charts, you want to run through the whole Mag 7 or all those charts from there.
Yeah, why don't we run through the whole S&P 500, and
There we go.
we'll do it Kramer style. I'll just yell buy or sell, and it'll be just a coin toss.
We'll save that for next time. I'll
Yeah,
get people excited about the next podcast. So, John,
yeah,
thanks very much for making the time today,
yeah. Good to talk to you.
and thanks everyone for tuning in. We'll be back to touch base on market action next week.